everybody. Thanks for joining us here this Saturday morning for Candid Coffee. I'm Jonathan Penn. Joining with me today is my advisor colleague, Rich Rosso. Hey, Rich, how you doing?
I'm good, John. How are you?
Hey, I'm good too. Hey, so we're going to jump right in here, but just a couple quick housekeeping items before we do. We are Clarity Financial doing business as RIA advisors. We are registered with the SEC, the Securities Exchange Commission. We are fiduciaries, and that always means that we have to put your interests first at all times. You know, we're going to have some fun today. We're going to make this educational and have some fun along the way. So we really appreciate everybody joining us, spending some of their Saturday morning with us. But Rich, before we jump in, we got a lot of great questions from the audience, and the chat's already just going crazy this morning, which is awesome.
Yes, it's too hot in Houston, Mary Lee.
It is hot in Houston, so the coffee is extra hot.
The heat index today will be 110.
Yeah, so you just keep your coffee on the sidewalk outside. It'll stay nice and hot for you.
We could bake cookies. We could, on the sidewalk, we could do whatever we want to do.
Scramble eggs, make pizza, all of it. So before we jump in, Rich, there may be some folks that this is their first time joining Candid Coffee. Mm-hmm. So kind of give us an idea of what is this about this morning? What are we going to do?
Well, this is what, when we first started Candid Coffee, we do it in our homes. We did it during COVID because we wanted to give people an ability to share what they were feeling, about money. There was a lot of fear in the beginning, and we couldn't go into the office. So, what are we going to do? So we created this open forum for questions, and it's morphed into something really successful for us because we have clients that sit on this. We have prospects. We have people who just listen to us, do their own thing. So we love to be part of your Saturday mornings. And, it's very casual. We'll give you as much information as we can. And we got a lot of great questions, but you also want to make sure you want to sign up for realinvestmentadvice.com and get be on our blog, go to our YouTube channel. We create a lot of content. It's a fire hose of information from Lance and Michael, me on occasion. I've been doing more writing, some workshops and all that. And John's on there. We just have everybody is an expert at what we do. So that's what Candid Coffee was. It was just like getting together at Denny's, but nobody's serving us any good stuff. I don't see anybody bringing me.
You have any pancakes this morning?
No. So, but that's what we started it for, to be very informal and make sure that we were helping people address their fears at that point. And it continued.
Yeah. No, look, there's no formal presentation, no formal agenda today. We have a lot of, even before this morning, Rich, we received, over 20 questions from the audience. Great questions.
I know.
And so it's really an open format. And to Rich's point, it's kind of like we're all sitting around the table drinking our coffee. The mug I have here has a Sasquatch on it, right?
It's really John in the mornings.
It is. That's what I look like when I wake up in the morning. Yeah.
Well, first of all, I think it would be good just to give everybody just an overview on things. So obviously, it's what I call, I'm a ham radio operator, a dead key, which means quiet across the stock market world, right? Everybody is pretty complacent. Volatility is low. And there are a lot of reasons for that. And Lance writes that, but we try to keep you grounded in the fact that it's okay to participate in markets at these times. Markets are always mad, even when they're calm. They can turn on a dime. And what I always say about us, John, is we'll follow the madness of crowds. We're just not mad. We have rules that will allow us to exit. We have rules around each position that allows us to trim if we're overbought and maybe add if we're oversold. And we look at this every day, all in-house. But we remain grounded in the fact that we have rules. We don't let emotions drive us. We don't let who's president, whoever it is, we don't let any of that do it, make our decisions for us. These are rules-based decisions that we make. So, but what we are seeing now is that economic data is absolutely downshifting when you look at over the first half of the year. So these higher for longer borrowing costs have definitely now are stinging. right? So you had personal spending down. And again, spending is 70% of the economy. Half a percentage point to an annualized 1.5% in the first quarter. Declines in orders and shipments of business equipment, the widest trade deficit in a couple of years, weakness in the job market, home buying, really the home affordability index, homeowners affordability index. I've never seen it as bad as it is. This is one of those short periods of time it's actually better to rent. This can't last for long. But we always said, I think we timed it a little bit too soon because we didn't realize the overall magnitude of the pandemic savings cushions, right? So it helped us to go out there and spend. So it's been a firepower, right? But now we're starting to see retail sales are starting to decrease. Executives are flagging caution among the shoppers about earnings season. So these pandemic windfalls that people had are starting to dwindle. This was $2 trillion in excess savings that Americans accumulated during COVID, and that is pretty much gone. So now what we're also seeing, that cushion is gone, fully depleted as of March. That's according to the Federal Reserve Bank of San Francisco. So now it's based on income. And for every quint, so when we talk about income, we have to look at real dollars after inflation dollars. Incomes peaked at around 2020 from a real basis, inflation adjusted basis, and now are negative. So I don't care if you're in the top quintile of earners or the bottom, you have gotten a cut in pay, and yet prices remain high. Now, the rate of change. So yesterday was a big day, right? We had the Fed looks at the PCE, price consumption expenditures. It's the PCE is just an easier way to see what's really driving the economy for them. There are so many ways to measure inflation. We track a lot of that through the Atlanta Fed, but it was flat. And what you're starting to see that the actual curve or the rate of change of inflation is going to target. It's about 2.6% year over year. Remember, the Fed's target's closer to 2. So it is headed in the right direction. But that has nothing to do with the fact that when you go to the store, you wince every time. You have higher prices. Whoever becomes president is going to have to understand the baked in the cake inflation. And what I mean by that is I never forgot to have a client that bought a birthday cake. She buys the same birthday cake every year. She buys the same cake, and it's always $15. And she called me. She was so distressed. She said, that cake is $27. Same cake. So I call that the baked in the cake inflation. Before COVID, she was paying $15. Now she's paying $27. So whoever becomes president in January, you have to say, I know my little client, my little old lady client, like my grandma, she's going to go to the store in February and get this cake again. And it's going to still be $27.
$27.
And she's going to go, what happened? And so in other words, we have to break up all the elements of the cake, figure out what's going on with input costs and the cost of goods sold. What's causing this input to be higher? Why can't prices go lower? And that's going to be a challenge. So rate of change, she goes next year, 2020, say 2025, she buys the cake, it's $27. 2026, she goes to the store, she buys the cake, it's $27. Now, the government's going to tell you there's no inflation. It's still $27, but that's not what you care about. So it's going to be very interesting to see how we handle those baked in the cake inflation elements that we deal with today. So we are definitely seeing a deceleration, but the market doesn't care because the market cares about where the Fed's going to go, which looks like one rate cut, and AI. So AI is estimated to increase productivity to about 2.5% per year for the rest of the decade. That's above what it's been from a long-term trend, say, since 2015. It's been 1.5. So there's this big push for AI. But we also don't think, John, you and I have been through the internet crisis, right? The tech bubble, all this stuff. Stories and narratives are very strong in the short term. And that AI story is taking over. sooner or later the data is going to matter. So I think next year is going to be a lot rougher year, and you're going to see more volatility as we go on. And that's something we have to keep in mind. So our job is to keep you grounded, be happy about returns, but understand the water's calm. But we know, John and I have been through many cycles, it doesn't last. And
yeah, remember
yeah.
Remember Y2K and all the noise around that?
Y2K. Yeah.
Oh my goodness.
I remember that Y2K. Yeah.
I remember.
It all got bastardized after the financial crisis. The Fed messed it up. They now decided that they were going to bail out markets. That never happened before. And then they continued. And then we sent checks to households during COVID. So in other words, we have trained a generation of investors to believe that they'll always be bailed out and cycles are dead. And listen, it's not their fault. I talk to Gen Z investors all the time. They sort of like stocks, but they understand risk. But they know the Fed's going to ride in on a white horse and bail them out. And that's a shame, because we should let cycles be cycles, but we don't.
So what I'm hearing is that we should actually allow a recession to be a part of the business cycle again?
That would be a cleansing kind of element for things to happen. We should allow business cycles to occur again, but we do not do that. So with that being said, we want to move on to some of your questions. Now, we track this stuff. We track the yield curve, which has been inverted, the 2s and 10s. We have questions about the yield curve, but I want to tell you something. And Mike Leibowitz writes a lot about yield curve. The lead time to a recession from the yield curve is it's a major range, 16, 62 weeks. You got to remember, the pandemic spending postponed any kind of contraction in the economy. You know what's worse than a contraction in the economy, John, is higher inflation, higher unemployment, and lower growth. And that's stagflation. I always say that we might be going into a period eventually of stagflation-like, because we're not fitting the definition of stagflation right now. But to be in that malaise is like sitting outside today in Houston, Texas, with 110-degree heat index and just baking and feeling miserable. And it never goes. And that's what I'm worried about we're going to see as we go forward, especially with all the debt we've taken on in this country. But we have to navigate through those cycles and make sure people hit their goals and hit their target benchmark rate that they need in their financial plan to make it.
Yeah, that's right. It's we are very long term with this from an investment standpoint. We are looking at this for the long term, but in the here and now. And I've heard Lance and Michael say this all the time, is that they're kind of managing what the market's giving them at the moment. Here are the cards that we're dealt with, and we need to manage through that too as well, right?
Yes, absolutely. We've got to manage through it. We've got to deal with the cards we're dealt and participate. So about the yield curve, yes, the 210s are slightly inverted. They have been for a while, but that does not mean you're going to get a recession right away, especially listen, there's still a lot of cash out there. I understand that consumers are drained, but the government loves to spend. We had the Inflation Reduction Act. We got the semiconductor bill. We got all this stuff. If President Biden gets in again, there will be even more spending. And that's going to be also money that's going to be out there in the system. Now, it's not very productive money. Although I will say, and Lance talks about this, the infrastructure money that's being used to rebuild or galvanize our electrical grids, that's important, because AI sucks up a lot of electricity. Right? This next iteration with data centers, I can't remember the exact numbers, but I've gotten some studies and I've been staggered by how much we're going to need to increase or improve our grid. And that's why even in our portfolios, we have, for people who know this, we sort of balance out the boring utility stocks, or the ones that will participate in what I call a diversified energy stream and actually build out their grids, as well as the NVIDIAs and some of the strong narrative names as well.
Yeah. No, great, Rich. Thank you.
I think PB Morel is like Ron Paul.
What's
and
that?
The Fed. Yeah.
And the Fed.
Yeah, there's a lot of if anybody, the Fed is not a government agency. In case anybody needs to understand, it's a consortium of banks, and it's not. It's and again, the way they handled interest rates over the past 12 to 15 years has been disgraceful. So we'll see how that works. So part of the diversified stream of energy that people are looking at, big companies are looking at, like Duke, is solar or wind. But frankly, that's a small part of it. You got to diversify the stream. The companies understand better what's going on versus the government. So keep that in mind. So it's going to be a lot of infrastructure money. And guess what? Those are productive dollars. Because if I build new facilities for electricity, I have to send bills out, and bills and get paid. In other words, that's productive. Look at the Hoover Dam. Look at some of the things we've done in the past. Yeah, we need nuclear, according to Gregory Smith, but good luck with that. But that would be really the most effective way to do it. But again, nobody wants to do it. So there are a lot of hurdles with energy right now. But again, we have to look where investments are going to be right, or sectors for our ETF portfolios that are going to prosper from these changes that we're going through.
Yeah, and I've heard Lance say this too, and I've used this analogy before, kind of a Wayne Gretzky. It's like not so much where the puck is now, but where we think the puck is going to be. So we have to kind of think or anticipate, based upon the Fed or economic changes and market environment changes, where do we think the market may go here in the near term, and interest rates, and how will that affect bonds, all these things. And Correct. So it's great that we have a very fluid approach where we can be dynamic in that aspect of things.
You have to remain so humble to the market. You can never be overconfident. That is the worst bias you're going to have. When people call and they say, I'm concerned about this, I'm concerned about this, I'm concerned about that, it's already priced in. So Marilee brought up uranium prices. Uranium has already run up dramatically, and we haven't even done anything yet. So by the time you're in that stage of actually needing it, prices will be down. The market front loads everything so quick today that you are going to miss it. You have to be in uranium when nobody's talking about uranium. I mean, it's very, very tough. That's why you see momentum trading this year so strong. If you look at the momentum index of stocks versus just your normal equal weighted market index, it's exponentially better, because these momentum stocks, these tech stocks, these chip stocks, they get more money as they head higher. But that is going to change eventually. So you got to stay grounded. You can't be overconfident. You can't be emotional with this market. You have to understand what you're doing. You have to understand the cards, as Lance says, you're dealt. Play those cards, play that hand no matter what, and know when to fold them.
Absolutely.
It's very hard for people to do. So I know we also got questions on, did we get questions on Social Security and some other things, or?
Yeah, we do. We have some great questions. And before we get into that, we're going to have some giveaways throughout our time this morning too. And so we have the wheel of names, the spinning wheel. So Brent, we're going to let you tee that up so we can do our first drawing. Okay. Well, excellent. So we have a winner, Jacqueline. So
yeah, the Candid Coffee mugs, they're really neat.
Yeah, Candid Coffee mugs.
Yeah,
they don't have a Sasquatch on them like mine does.
No,
so.
We were thinking about it. Yeah, it is. So thank you very much for attending. So
thank you, Jacqueline. We'll stay tuned. We'll be doing some more giveaways here throughout the morning. But so Rich, so let's get into some of the questions that we received, specific questions. And some of the questions that we received, some of them were a little bit repetitive, so I might group some of these up here a little bit.
Yeah, they will be.
A lot of questions around Social Security, and it seems that the common theme around the questions that we're receiving around Social Security is, what's the viability of it? Should we be concerned about our benefit being reduced or means tested, or just what's the financial health of Social Security? What do you think?
So obviously, the Social Security system needs help. So I look at the Social Security Board of Trustees report. It releases it every year, and it combines the asset reserves for the old age and survivors insurance and disability insurance and trust funds. And there's enough dedicated revenue now to pay all benefits and administrative costs. And by the way, the administrative costs for Social Security, believe it or not, even though this is government, it's astoundingly low. It's barely anything. I know, go figure. So it's projected to go out an additional year. It was slated for, say, 2034 to have trouble, but it looks like 2035, with 83% of benefits payable at that time. So we're at that point where we have enough time to fix it. We don't have to do anything major to do that, to continue to pay benefits. I don't let these kinds of things drive your Social Security decisions. So here's how it works now. That total annual cost of the program is expected to exceed annual income this year. And it's going to remain higher because they project out 75 years, by the way.
Yeah.
So the total cost began to be higher than income in 2021. So that now you have to realize that, and by the way, people always go, what's in that trust fund per se? They are legal instruments. They are backed by the full faith and credit of the United States. They are a form of Treasury bond, okay? They have the same legal status as bonds bought by you or me or a foreign government or any other person by entity that invests in U.S. Treasuries. So it's not like it's invested in anything real speculative. We back it up with our full faith and credit, but you do need to tweak it because people are aging. Our demographics stink. We're all not having enough babies. Your children, tell them to go out there and have some babies. We're not having enough children to carry the system. Obviously, mostly funded by payroll taxes. So you need more workers and paying in. And that's how it would work. But you can tweak this right now and really make it viable. So I won't let my decision today affect me in 2035 because, listen, Lance always talks about it's a math problem, and it is. But a majority of individuals, older Americans, depend on Social Security as their pension. It wasn't designed to be this way, but we don't have defined benefits plans anymore. So you can't make your decision. So I have clients that are very unemotional, and they'll run plans, and they'll say, Rich, I understand what you're saying, and I'm going to be emotional about it, but I'm going to take my Social Security earlier. Which means you're also going to mess up your survivor benefit for your spouse who has not paid in as much. So I have people that will even recognize it's an emotional decision and still do it. So we understand that there's narrative. Like if I take Social Security, I'm sort of protected. Like my benefit won't be cut by 20+%, right? My benefit won't be cut. Everybody else's will. Well, why can't the government just cut your existing benefit? There's nothing out there that says the government can't. Like I'm trying to figure out, like, if you feel that you're grandfathered in and you've been getting benefits for years, that you're protected somehow. That's like a magical decision. If you're not. So Social Security is not a break-even asset. It is a longevity risk asset. If you live longer or your spouse lives longer, we lump sum it, right, John? We show people, listen, if you take Social Security for retirement age versus taking it at age 70, which is a bump called delayed retirement credit, here's how much you could have. We will show you break evens, but we have to remember people are living longer today. And this is a guaranteed form of income. Hey, you could do it yourself. What I mean by that is you can create your own pension. You can buy an annuity. That's what Social Security is to complement Social Security. But we want to make sure, right, John, especially when they're surviving spouses, that we are doing the right thing for both of them in a very unemotional manner. And if we didn't have, I told Lance, I understand it's a math problem, but if we didn't have Social Security, we'd have a lot of people living on his lawn.
Well, you want to see, so you want to talk about riding in the streets, that'll do it, right? Mm-hmm. And that'll do it. And it can't go away. And I mean, there's a lot of validity around the concern or just around the questions about the viability of Social Security, because, you know, it is become something that it probably wasn't intended to be.
It is.
We all are living longer. And now there are ways where folks can, you know, just earlier this week, I was helping a spouse who had recently had gone through a divorce. there are some rules in there where, they were married for 10 years. She is not remarried. They are of the age where she could probably collect her benefit based off her ex-spouse's record from a divorce's benefit. So there are other strains on the system out there. And so the concerns, they are valid when it comes to Social Security, right?
That's right. And again, like P.D. Morrell said, there's no politician that's going to get reelected by banning Social Security. You cannot ban Social Security. It's not possible. You can tweak it, though.
Yeah.
You can tweak it, though. And some people do live longer. So here's the thing. I know a lot of people who know when they're going to die. It's the strangest thing I've ever seen. Oh, no, I'm not going to live till 70. I'm not going to live till 80. No. I'm like, how do you know? Well, my parents and okay. I'm 60. My parents died at 52. Like, am I on borrowed time, or is my lifestyle different than theirs was? Okay. My lifestyle is very different. I rarely drink. I don't do what they did. And it's, that's lifestyle is a very important factor. So I will look at Social Security as such, but I have no idea when I'm going to die. But people are doing that to justify a decision to take Social Security. And my question is, what if you don't?
Yeah, what if you live?
What if you live? So keep that in mind.
I mean, I'll tell you, Rich, there are a number of individuals that I work with that are in their, 70s, 80s. They look younger than I do because they take so good care of themselves, right? I mean, folks are living longer these days.
Some of you in the chat who have been attending this, do you remember your grandparents? Like, my grandfather retired at 65, and he looked 85 to me. And he sat and watched TV for a few years, and then he passed away. Right? I mean, 65-year-olds today, oh my gosh, to your point, John, I mean, like, I'm amazed by how active, and there's all this technology and all this new innovation in technology, biotech, biomarkers, understanding your blood chemistry. There's so much that is going to make you live longer, but increase the quality of your life, that you have to be you got to be really unemotional about Social Security. So again, it's important. We always do what you want to do. But so here's a couple of things. You raise the payroll tax, you tweak it a little bit, you raise it a little bit, you increase right now you only pay wage payroll taxes up to what, 160,000?
Like 168.
Yeah, right, 168. And then what'll happen is after that, you're not paying payroll tax. So all I got to do is maybe take the lid off that. Hey, listen, I'm not a big fan of paying taxes anymore. Frankly, I do it, of course. But payroll taxes, I know where that goes. I know it goes to help people who are retired, and I greatly respect our older Americans who work really hard and they deserve that money. So I understand it. But all I have to do is say, if you're born after, say, 1980, I'm going to increase your full retirement age to age 68. 1 year. I don't have to do a lot to make this system viable. I think President Trump was talking about if he got elected, they would look at more merit-based immigration. I don't know if that'll happen. And again, I'm not being political about it, but a merit-based immigration would be really good because you would have people that have skills we require and pay in. Right? Because we're still, even though we look like the cleanest dirty shirt, we're still the best country in the world. I know it's hard to believe that. But I mean, look at international stocks, John. Look how we do asset allocation.
Yeah.
We haven't had international stocks for as long as we've had the firm because they don't perform. People put it in the portfolios because the compliance department says you have to have it, but it's not adding anything to your returns.
It's been more like an anchor as the blade.
It's been an anchor. Now, it doesn't mean we won't. So keep that in mind. When you go Social Security, we run analysis for you as clients. Take the emotion out of it. We look at your record. We look at your health. We look at who paid in more and help you come up with the right strategy. And the trust fund is okay for now. Yeah, look at Timothy says, my dad will be 90 this October and still driving. I think, and he retired 27 years ago. I mean, I have clients that are the same way. I'm amazed.
Yeah. So I just about 3 weeks ago had a Zoom call with a client. He's in his early 80s. I think he's 83 years young. He doesn't look a year over 60. And he said, and I said, what is the secret of your success? He goes, I've got one tip for you. And I said, what's that? He goes, do your own yard work. That's his thing. He loves being outside. He loves being active. And I swear,
Be
he
out
doesn't
there
look a year
and
over
sweat
60.
and see something. It's so different.
Yeah.
So it really is. So we got an interesting question. I'm going to deviate a little bit. We got an interesting question from Paul. Any anticipated changes to the percentage return built into RIA's plans based on current yields and inflation? So let me explain this to you. When you go to a financial advisor, they take their little planning software out of the box and they go, whatever the inputs are in there by the company that did the program. We don't do that. We study inflation. We study forward-looking returns in asset classes and adjust accordingly. So about 4 months into the pandemic, I went ahead and increased our baseline inflation rate to 2.5%. The program is at 2%. Now remember, this is just the baseline. About a year later, the program creators came out and said, hey, we're raising the baseline to 2.5%. That's how well we study this. We also study inflation per every goal you have. Medicare, long-term care, all those inflation goals are updated. But keep this in mind. If you're facing inflation right now, your plan is based on the rate of change of inflation, what inflation is going to be. So with the rate of the baked and the cake inflation that's in your plan, that's where inflation is now. We're looking at where inflation is going to be. So guess what has to change? Not our inflation rate, your budget. You need more money to buy the same number of goods. So my rate of change is very accurate, unless I see something that changes that on a macro level. Also, we analyze long-term returns of every asset class. That's large companies, small companies, and we put them into our plan. If you go today to a wirehouse and run a plan, they're going to say, oh gosh, you're going to get like 10% rate of return on stocks over the next 10 years. They're looking backwards. So your plan works today. Oh gosh, I could spend all this money. I'm going to get 10% a year. And then next year, you're going to have a garden variety 10 to 20% pullback and correction. And guess what's going to happen? Your plan is going to fail. We base it on CAPE, cyclically adjusted price to earnings. So Lance does the work on that. I have triggers that will allow me to change those asset classes. So in other words, about 2 years ago, I did increase the returns on bonds. I did increase the returns on bonds, but I left stocks alone. Okay. We are here to give you the most realistic rate of return that you might get over the next cycle. And where the CAPE is, the median CAPE, right? That's what we look at, the median. It'll take you 38% correction to get back to the norm. That's how extended these markets are. So when you're retiring now in a headwind for returns, and I hope they never happen, John, and I hope they never happen. But if they do happen, your plan is not going to be interrupted. So the conversation we're going to have is, oh gosh, we were really off. You're going to have more money to spend. I'll have that discussion all day, John, versus, gosh, your plan was at 95% success. And then based on this, whatever happened in the market, you're at 55%. You want to go to Walmart and get a job? I'm not having that. So yeah, I did the adjustments in 2003, 2012, and then 2018, 2019. And I looked stupid for a couple of years. But we have to prepare you realistically for what we might come to. And that's like you talked about the Gretzky comment. We're skating to where the puck will probably go based on math and valuation over time. And if we're wrong, you have more money.
Well, and so that's the key, right? So when you're talking about the plans and putting these plans together, you know, and as you know, Lance and Michael, the whole team, we all pay so close to what the markets are doing. What we want to figure out through that financial plan, when you're talking about your hurdle rate, what is the rate of return, regardless of what the markets do? And we all pay attention to that. What is the rate of return, Rich, that you need to earn over time for this to work, right? And then, and what's the amount of risk that you really need to take with your investable assets to get there, right? So it would be very easy for us to use historical market averages to put your plan together looking forward, great? But we would much rather use conservative forward-looking rates of return. And if your plans are still successful using those conservative forward-looking rates of return, hey, in those years, like a 2021, hey, even this year too, you know what, go spend a little money. It's all right.
We were running plans, do you remember? Existing plans, and we were telling people, you don't have to change anything. And they're like, what? No, we don't have to change any of your spending at all. Because of how we reacted during the pandemic, we went down to almost 5% stock. So we didn't take the brunt of the downside at all. Yes, we were hurt, but nowhere near where the market was. So you have to keep in mind that I have triggers unemotionally to increase returns. And so far, my increase on inflation and my increase on bonds based on yields worked. Now with stocks, it's going to be tougher. So we create this benchmark rate. You want to exceed that benchmark rate or at least meet it, because that's what you need to meet your goals. And that's where our plans are alive and breathing, and they're incorporating academic research and the research from RIA advisors, because I also use Research Affiliates, which is a great fundamental think tank, in my opinion, and to see what they're thinking about valuations, because they're looking at markets in over cycles. And that's what we're looking at. So if these change, we have to actually go into the planning software and update every asset class manually. But we'll do that. We will do that.
And yeah, and we are live this morning. So sorry, I had a little dog out there scratching open our door. She may come in my lap here in a minute. But you know what? I think it's time for another giveaway, Rich. Why don't we spin the wheel of the wheel of names? And Stacy wants the mug. Very good, Stacy. We'll get you.
That's a cool mug. It's our Candid Coffee mug. Instead of vapor coming out of your coffee, hot coffee, it's dollar signs. So
I like that.
Thanks, Stacy. So let's talk a little bit about, we had questions on gold, because we want to keep.
Yeah, a lot of questions around gold, and just so we'll spend a little bit more time getting into some of these questions here. A lot of questions around gold. Rich, what do you think? The best way to store it? Is there any one way that makes more sense than the other?
First, I got to do my Austin Powers gold member impression. I love gold. Listen, I think the best way, and there are a myriad of ways to do it, but I think the best way is having a safe at home. I think that's what most people will do for coins, collectibles, gold, silver. They will have a safe. Now, you can use a safe deposit box at the bank, but depending on the bank and how you register that box, going through probate, that can be heck getting into it. But that is also another option. So those, and again, it could be stored elsewhere, but I don't think you all have enough gold to do that. So I don't think that's worth it. I think it's worth it to have the safe and to do it.
Yeah, I've noticed that too with folks that I work with that own a certain percentage of their overall portfolio in precious metals, gold, silver, what have you. They typically invest in a really nice safe, and that's where they keep it. They just keep it at home in safekeeping. But I get a lot of
to keep it in their gun safe, like they have a gun safe,
yeah,
big one, and they have a drawer at the top, and they keep their gold up there. That's fine. I mean, anything like that will be helpful, just as long as if you pass away, someone has the combination.
Yeah, you got to have that too. So what about gold ETFs, Rich? What are your thoughts around that?
I like them because they're liquid. It just depends on how we use gold as a trading vehicle. Gold. I have nothing wrong with people owning gold. I have nothing wrong with people owning Bitcoin, because you should have rules around any investment you own. I mean, I have people that are asking me about DJT, Donald Trump's, the Truth Social, right? No fundamentals whatsoever. It's really based on Donald Trump, right? I can't recommend it. I wouldn't recommend it. But I'm like, if you want to own it, you realize you could lose all your money. That's fine. You want to make sure you put risk parameters around it, right? Anything you own, you want to know how much of it do I want to own? How much would it impact me if it drops dramatically? So I'm a big fan. You want to own Bitcoin? Fine. You have Bitcoin ETFs. I'm fine with gold ETFs. We will use those because there'll be times we want to own gold because gold goes through long periods of outperformance and underperformance. Marilee goes, put it in a cereal box in the pantry. Listen, I have one client that used to put it in his dirty laundry. So I don't recommend it, but listen, those cereal boxes are so small. Can you fit gold in there anymore? They're like, shrinkflation. I picked up a box. I don't have big hands, and I was like, oh my God, I feel like a giant picking up that box. I mean,
your Captain Crunch gets a lot heavier when you put the gold in the box.
Yeah, can you imagine? Yeah. Oh my gosh.
A lot of marshmallows in there.
It's got a lot of vitamins in it. Yeah, green monster boxes. Those boxes are good. So anything that's secure, but again, there are some unorthodox ways that people do it because the gold hides in plain sight and no one's really going to look for it. You better know. Your heirs better know where it is, though.
That too.
That's
But I think a lot of the folks that we visit with, they kind of have gold as a piece of their overall investment portfolio. It's all about balance. If you're concerned about buying gold because maybe doomsday is coming and you're going to have to go out there and go down to the store to buy a loaf of bread with your gold coins, not so much, right? But as part of an overall diversified strategy, sure.
Listen, you ever see the movie The Book of Eli with Denzel Washington? It's the end of the world. Do you know what the medium of exchange was? Wet wipes.
That like oil from cats. Remember that?
Well, cat oil.
Cat oil. Remember that?
What I'm just saying is like sort of gross, but what I'm saying is you're not going to have this phase where the end of the world and you're going to go ahead and use gold. It's just not. If you're using it as a diversifier, as a way to protect, as a legacy asset, gold won't go to zero. You can lose money in gold, but it's not going to zero. So I think it's a hard snuggie for a lot of people who also romanticize that we're going to go back on a gold standard. That's not happening either. So having a little gold or having physical gold, or when we will trade it, gold really tends to do well when the Fed's in the process of cutting rates. It's not faith or lack of faith in the currency. It's faith or lack of faith in the Fed. So once the Fed is cutting, and you're in a disinflationary environment, actually gold does better because I can show you inflationary periods where gold hasn't. So again, Lance and Mike write so much about gold. If you go to Real Investment Advice, go to Insights, hit blog, type in gold, my gosh, you will get an education.
Yeah.
So nothing wrong with it. I'm an investor agnostic. I don't care what you own as long as you have rules around it. You don't fall in love with it. And you have the guts to sell it if it doesn't work out. I don't care what it is.
So here's a great question, kind of going back to the plan side for a moment. I want to get to this question that Rick sent us, Rick from Florida. Thank you.
Okay.
Rich, key considerations in your experiences to evaluate whether a reverse mortgage for retirement income is worth doing. How do we approach looking at a reverse mortgage, and if it's something that even makes sense?
Well, so your house is an asset, and a lot of people are house poor. I worked with a client. Yeah, it was confiscated, Matt. Gold. Matt's talking about gold. If they want to take it, they'll take it. But you gotta add, yeah. I mean, it's not going to be your ultimate protection. So, what are we talking about here?
Things to think about with a reverse mortgage, or how to incorporate that into a plan?
Yeah. Reverse mortgages are not what they were. They were considered predatory. Quite frankly, were they predatory? But when you look at where people spend the money, you also wonder, okay? A reverse mortgage, or we're pulling liquidity out of your home,
right,
is a way to turn this hard asset, illiquid asset, into liquidity. It could be part of your retirement income stream because you don't need to pay it back. And if you're going to stay in your home and you want to age in place, which is popular by like 85% of the older population, they want to stay in their home. They absolutely can do it. Yes, there are fees up front, Yes, there were charges. They're nowhere where they were. You even have to take a class. But when we do it in our plan, we want to figure out even before the reverse mortgage, do you even need it? Some people will put reverse mortgage, what we call home equity conversion mortgage lines of credit in place. This line of credit, say you put it in place at age 62, which is the age you need to be, and you don't touch it. You don't touch it. You're going to say, listen, this is for my long-term care costs. I am going to touch this money probably in 25 years. That line of credit grows with the value of your home. So you have to be a good steward of money to use a home equity conversion mortgage. I have clients that were house poor. They didn't want to relocate. They didn't want to downsize. They were able to get a lot of money from a reverse mortgage. And we came up with a system to pull money out periodically to complement all the rest. That loan does not need to be paid back. Yes, you need to pay your taxes. Yes, you need to upkeep. That is still your home. But when you pass, that home is sold, loan is paid off, whatever's left is left. There's insurance in place just in case your line, your amount you spend exceeds the value of your home. Your heirs won't need to come up with, oh my gosh, mom and dad took $100,000 over the price of their home and we owe $100. No, you buy insurance inside this reverse mortgage to protect against that happening. It's not for everybody, but don't avoid it.
Yeah.
It's part of the planning to show if you need it or not. I mean, I've had like 1 out of every 7 or 8 clients that could be using it for long-term care cost of something else. But it can be a very viable part of your retirement income, especially if you want to stay in your home. I had one client, she just passed away. She was a client of mine for years. Actually, John, I think you referred her to me back at Charles Schwab.
Back in the good old days.
Yeah, she was house poor. She was barely eating, and she had this big house. I'm like, wait, we have no liquidity. And we put one in place and set up a system that allowed her to tap it. She passed. They're going to sell the house. The house value actually exceeded the value of the loan. The estimate for their house versus how much it really was, it was actually more of a windfall. So when they sold the house, there were going to be proceeds left after the payoff of the reverse. So it can work. It can work. You can go to retirementresearcher.com. Wade Pfau has a great retirement calculator and a lot of education. He's one of the best. We read all his books on Wade Pfau, PFAU. And you can get a lot of good insight into reverse mortgage.
Yeah, no.
We got to be cognizant of time here because we only have 12 minutes. We always go over a few minutes, but it's going to be a nice day, and we don't want you to melt if you want to go work outside. So what else do we got?
So also a lot of questions around, treasuries or just the easiest way to buy treasuries. I know that, Treasury Direct is out there. I've heard at times that website can get a little clunky. But I didn't know, Rich, if you had any thoughts around if somebody was looking at buying some short-term treasuries or wanted to add treasuries to their portfolio.
Oh, it's so easy. Listen, you can go through Treasury Direct. That's easy. You can open a Fidelity account, buy them online yourself, talk to someone at Fidelity to do it. It's really, I don't buy in the auction. I would just buy the secondaries.
Yeah. So you can buy them directly through the bond desk at Fidelity. If your accounts are, you mentioned Charles Schwab, you can buy them directly through your account at Charles Schwab. They have a very large bond desk there.
It's
easy to buy. If you need to sell it, they're easy to sell.
Very easy and very little commission on these. It's not like you're not going to pay a lot to buy these.
Yeah.
But I think they're good. But keep this in mind: rates are going to go down. If you have all your money in the short end in money markets, paying 5%, and you're loving life. In the next 2 years, you're not going to love life. I don't think we're going back to pre-pandemic levels, but you're going to see that rate cut. So what you want to look at now is if you're longer term money, if you want yield, go out 2 years, go out 5 years. We even have cases, we have some 10-year bonds, right? If you want to lock in and not be subject to reinvestment rate shock, when rates come down, that's going to hit your money market immediately. So these 5% yields, if you're all on the short end of the curve, you're okay now. And even after one rate cut, you'll be okay. But I think next year or even the year after is where you're really going to start to see them.
Yeah.
So you're
So one of
on
the
borrowed time.
So one of the questions that we received prior to the conversation was from Tom about, hey, does it make sense maybe to go out, 12, 24, maybe out to 36 months, kind of stretch out even though right now, to your point, the yield curve is inverted. You're getting more yield from your money market right now.
So you're
That
not
three-year
like doing the
treasuries,
Gretzky thing, like you talk
yeah.
about. You're
So
going
the
where the
three,
puck is going to go with you, not where it is. So, right. So go ahead.
yeah, no, you're right. So even though a 3-year treasury is probably paying you less yield than what the money market is, if the Fed starts dropping rates, all of a sudden that 3-year yield that you have locked in out here is going to start looking pretty nice, right?
Absolutely. So you don't want all your money there. We barbell it. We have longer duration and sort of shorter duration. Now we're starting to spread it out a little bit to intermediate because that's what you want to do. And it could be CDs. I use online savings banks. I tell all our clients about that. Ally, Marcus, Synchrony. These banks are FDIC insured. Their rates are always going to be better than your brick and mortar bank. Like just on cash, Ally is like 4.2%. But you can lock in 2-year CDs. I think they even might have 3-year CDs. I think 3-year CD is roughly 4%. 5-year CD is 3.9. Because I think ultimately you're going to wind up around 3.5 is probably where rates will stabilize from where they are now. So I still think you can get better yields on cash, but rates are absolutely headed lower. So you want to take some of your money and move it out. Not your emergency cash, but yes, I absolutely agree with that 36-month premise quite a bit. We also had a question on Roth, and I can't find it, but so thank you, because if I had to do my life over again, and I think that was one of the questions, if I had to tell my younger self one thing, not that I had these at the time, I would never put a dime in a 401k. I wouldn't put a solitary darn dime. I tell the kids today that come in to see me, children of clients, and any Gen Z, I tell my daughter who's got a Roth IRA, Roth 401k. That's what I
would. Roth 403B.
Roth 403B, Roth Simple IRA, Roth, because if you think taxes are going lower in the future, you're not well. And keep in mind, when you retire in the 90s, when I started in the late 80s, early 90s, you retired into the lowest tax bracket. You don't anymore. If I consider Social Security taxes, you are taxed on your Social Security benefits, and what we call IRMA or Medicare charges, depending upon how much earned income or ordinary income you have. So your effective tax rate is higher than you think. So I tell the kids, what do you think tax rates are going to be? Roth is going to be best for you. So someone had, I cannot remember her name. Maybe you want to find it in there. She had a wonderful question. Her and her husband are contributing to Roth, and they're estimating their income because what they have to remember is there's a modified adjusted gross income threshold to how much you can put in a Roth. But I will also ask a question. Do you have Roth 401ks at your place of business? I would do Roth 401k first. I would shut off my pre-tax, turn on my Roth. That's a good way to do it, and you have no modified adjusted gross income limitations. So if you're married filing jointly, you have to have under $230,000 to contribute the full 7. If you over contribute because you just said, hey, I'm putting it in, but our income may not wind up, you just remove the excess. It's really easy to remove the excess contribution through your custodian. But my priority right now, and companies are going to have Roth options because the Secure Act that's been written portends to more Roth. If you make, for example, I think this is going to come into play in 2026, if your modified adjusted gross income is $146,000 or more, any catch-up contributions you make into even your pre-tax is going into Roth. Why does the government love Roth, even though we were told that the government really is going to attack Roth? Why does the government love Roth? It's the J.G. Wentworth of accounts. The government needs money now. And Roth is the way to get it. So I call the Secure Act 2.0 the Rothification Act. And I actually think it's great.
I do
because
too.
the government is short-sighted doesn't mean you need to be. So you pay a little taxes now. There are studies out there, John. I use it on our retirement classes. There's a study that will show you, even if you're going to fall into the lowest bracket, Roth is still the better choice. It came out of Harvard. The writer's name is Bashir's last name. She did a wonderful job showcasing how, regardless of your tax bracket, Roth is the way to go. So if I had to do my life over again, there are two things I would do: Roth and permanent life insurance. I wouldn't go near a pre-tax account. Yeah, I don't care if I'm saving money now. I want a big bucket of tax-free money at the end. That's what I want. That means my Social Security is not taxed at all. I get every penny of my Social Security tax-free, per se, as far as taxes coming in. That's what I want.
Yeah, a lot more flexibility with how you can control your tax bracket when you're older, right? So what can you do now to set yourself up for that? And Christy, your question is so great.
And, it is great, yeah.
And remember,
Matt,
go ahead, Rich.
No, but Matt, you could do a backdoor, but you got to remember those are after-tax contributions. You can only backdoor it. You can do after-tax contributions. Your plan will allow after-tax, and then you can do that backdoor Roth. The backdoor Roth outside in like an IRA environment, you got to be really careful of certain pro rata rules. If you have IRA rollovers and so forth, that's beyond the scope of how much time we have left. But I have clients that will purposely do money in after-tax, retire in their retirement plan, not pre, and then do these backdoor Roths, mega backdoor Roths. It's very smart.
Agree. And to further Christy's question, if you are looking at making a Roth IRA contribution, if you haven't, so it's 2024, you actually have up until April 15th or your tax filing deadline of next year to make a contribution for 2024. So you can have a better idea about what your income looks like at the end of this year. You don't have to make a Roth IRA contribution for 2024 in 2024.
You can wait. I mean, she may just want, I always think of putting money to work early. So I get the rationale for the question, but that's a very good point, John.
Yeah. Oh my gosh, all great questions, and I love the chat. Thanks everybody. Let's. I think we're ready to do our third giveaway. Why don't we let Brent spin the wheel of names for us all? All right, Mike. Hey, Mike, we really appreciate you joining us this morning. We'll reach out to you and let us know if you want the Candid Coffee mug, if you want the keychain, or you want the snazzy little lapel pin. All right. Thank you so much, Mike. We appreciate it.
The last thing we'll talk about is, and by the way, go to Real Investment Advice, sign up for our newsletter. We do the show every day. Lance does. John and I, you'll see us on Fridays on Financial Fitness Friday, but it's also on YouTube. So we talk about a lot of different topics. And there'll be a survey at the end of this. Any topics you want to have, we always try to keep Candid Coffee as an open forum, but we also do lunch and learns. So if there are any specific topics, the wheel of swag. Erica says that's funny. Well, when it comes to long-term care costs, we calculate those into our plan. But we are seeing a lot of companies that issue long-term care surprising us with hikes in prices and giving you options to get out of your current plan, because they never anticipated longevity and how much long-term care would have to be, benefits would have to be paid out. So it's really tough. We build them in the plans to, the rate of inflation is about where it should be, but you're going to see a lot of pure long-term care companies say to you, or you get a letter saying, if you don't take another option, we're going to increase your premium by 100%, which means they're pushing you to do it. So you got to go through it with your advisor and make sure that you have the right choice, because that's the problem with long-term care, pure insurance, right? Is that you can be surprised. Genworth is going through this process right now where I'm working with a lot of clients who have Genworth and they have great policies, and they're saying, listen, if you take this policy, you are going to double your premium if you keep it the same way. And a lot of people don't want to do that. So there are
Yeah,
different options that pick and choose certain things. That is going to be a challenge. So there's really no way around that. Some people have just dropped their policies. I hate to say that, but they let them go. They said we can't afford them, and that's really a shame to do that. The cost of living adjustments for Social Security can help with those costs, but again, it depends on where Medicare premium costs go, which sometimes wipe out your entire cost of living adjustment. We had some really nice couple of years there, but now we're going to be based on maybe 3% or less, which is the long-term trend for cost of living adjustments for Social Security.
Yeah,
That's the beauty of using your home to supplement long-term care costs. If you're married, that's very helpful because your spouse will be partially caregiving. In other words, it's never perfect with long-term care coverage. We have people that are living in assisted living and they're seeing their prices go up. It's really tough to counter that because in your contract, you sign a contract that says this is what could happen. And if they take advantage of it, then you have to cut in your budget. I have some clients who are older that have taken part-time jobs. Not that I'm saying that's an optimum solution, but they've done that.
Yeah, those long-term care, I've seen several of those letters that clients are receiving from Genworth about what their options are.
Yeah.
It's like a whole matrix with maybe a half a dozen or more different choices. And after a while, all of that kind of bleeds together. So it's good to have a second set of eyes on that to help you through that decision process.
Because you can't just go by price. You have to look at inflation factor, right?
That's right.
You have to look at elimination period, how long you need to wait to get your benefits. I mean, it's a whole thing. And they don't go through it with you. They just give you the grid. Good luck.
Yep.
So, well, I think that's all we have for today.
I think so too.
We really love you all being here, and you had some great questions and commentary. So we so appreciate that. We would love, again, in the survey, let us know what you think. And Christy Kearns, I watch your show every morning. I'm in my 50s, learn so much. Oh, thank you. Love Fridays. Thank you so much. Let us know if there are really other topics. We will do long-term care as a topic for sure.
Medicare.
One of our lunch learns Medicare, Social Security, we cover those. But maybe there's something else on your mind that you want to talk about. Yes, and Lance is on Thoughtful Money with Adam Taggart every Saturday mornings at 8:00. So I guess you can find Adam's Thoughtful Money podcast out there, and they go through a lot. It's very dense. Let me explain this to you. If you're going to sit in on that, you got to really love this stuff. And if you do, Adam and Lance are really a good team on that Saturday morning.
Agreed. My dog agrees too in the background, by the way. They get excited.
He gave an endorsement there for sure.
That's it. Yeah.
Thanks, everyone. We appreciate you. Hope you have stay cool, stay hydrated. We'll see you at the next Candid Coffee.
Thanks, everybody.